Gentlemen, it's so great to see you here this week. Welcome, welcome. Can't wait to get started. So, Stephen, let's begin with you. What have you brought for us?
I want to return to the United States of America, which is...
you're going to go visit
I'm going to go now,
yeah.
right now, as soon as I've said what I'm going to say.
Film it.
Yeah. Which is, as you know, remains a favourite of mine. I think I probably haven't talked about it for probably about a year, actually. But it's done very well in recent months, and particularly this year. The main markets are hovering very close to all-time highs, and certainly have hit all-time highs in recent months. And I remain quite positive about it, certainly medium-term, certainly long-term, would retain it in the portfolio. But I'm a little bit cautious at the moment, given that everyone's concentrating on the very good jobs data and all the rest of it. But if you look at things like exports, they're slowing. I'm not so worried about the slowdown in QE, but consumer confidence is also looking a bit under pressure. So I think in the short term, I'd be very careful of buying at these high levels.
I mean, I think that one of the interesting stories is that you probably would, if you had to have a foreign currency asset, you probably want a dollar asset. And I think dollar is unfortunately, if Americans are going to possibly strengthen, I don't think the Americans would be terribly happy about that, because I think they'd rather the dollar weaken so they could export more. And I think that may have unintended consequences. I think that America is still probably the least worst of a bad bunch, is the way I'll put it, in terms of shares. I struggle slightly more with the US T-bills and T-bonds, but they're a safe haven. I think America is quite interesting, and I think actually, and it goes back to what I really want to talk about, which is, and it's partly because of our energy, really. I mean, we all know the story. We've probably heard it a lot now, but people are putting some quantifying actually what the energy kind of productivity boost is. We're looking at potentially between 0.5% and 1% of GDP. Now, growth over the next couple of years is going to be related back to cheap energy, and you're seeing onshoring of things like big US chemical refineries and oil refineries. So that story we sort of already know about. But what I think is quite interesting is that actually it could benefit, that it could turn, which is that natural gas prices have started rising again. And actually, I think this is probably good news, even better news for American businesses, because I think a lot of the businesses that in the natural gas sector, particularly the fracking sector, haven't been making big profits. Actually, quite the opposite. In fact, a lot of them have been losing money because gas prices have been so low. So that's been good for America. It's not necessarily...
It makes things more economical to be able to do them.
Absolutely.
That's the big
it's been good for America. It's not necessarily been very good for the companies concerned. Whereas I think what's happening now is that natural gas prices are starting to gently rise, and they are still very low. So therefore, I don't think America's going to see much. It's not to the American economy's great detriment. But I actually think it's quite good news for the American energy sector.
Terrific. So short term, don't worry about some of the signals we're having now, and over the long term, pretty good for the good old US of A. Well, I'm happy.
Yes, I'm sure you are. I think it's probably not as good news. I think it's not quite as good news over the long term for the US as it wants to, because actually I think that strengthening dollar could be the weakness, basically. And in fact, what they, in fact, if one was Machiavellian, what we might actually say is that the central bankers are trying to manage this difficult trade-off between withdrawing QE, managing the exchange rate, and managing the unemployment rate. And it's very difficult to get all three of those going right. So I think that
for UK investors, don't forget, that exchange rate has a big impact on your real returns. So it's not just that we're seeing markets at close to an all-time high, which could come under pressure. But the strengthening dollar can have an impact as well, and I think that in the short term is what would concern me.
Good. Okay. Even despite some export worries with the strengthening dollar, we're not going to worry too much about it, because right now I'm a little bit curious, because you said you had some sort of revelation.
No, my revelation. Yes, and my revelation it's potentially earth-shattering, but no, it's not. It's very straightforward. I've decided to stop paying into my pension plans, and I've decided to completely focus on ISAs.
And you're just not going to retire.
Yes. But I'm going to retire, and that's my point, Stephen. I'm going to retire when I want to, which will probably be about 85. And the reason for that is that I was chatting away recently to two people. So an actuary who works for the government, and to a policy advisor for the government. And what was quite interesting is the numbers on longevity are well, it depends how you look at either. Brilliant news, because we're all going to live a lot. If we get to 65, we'll live a lot longer. Or terrifying news, because actually, I think it's going up by 0.4 years every 10 years or something like that. Yeah, and I cannot believe that by the time because of course you are both much younger than I am, By the time I get to retirement age, it's not good. The retirement is going to be 75, and you're probably not going to be able to cash in your SIPP until you're about 65. I think it's 55 now, and I think it will be 65 by the time you get there. And I've suddenly decided, okay, so you get all those tax benefits from the SIPP, which is great. You know, you get tax relief on the way in. You get taxed on the way out, though, and you can't control what you want to do with it. And I've basically just decided I'd rather actually just put most of my money now in an ISA, good old, with stocks and shares and bonds and that kind of stuff.
What do you think about that, Mr. Isa?
A lot of people use ISAs as part of their pension planning, and I think it's quite sound because you can build up this pot which you can draw an income from, and it gives you a lot more flexibility during your lifetime, which the pension doesn't. It's locked in there. But of course, the pension gives you that tax relief, and that's what's really attractive about it. It's 40 or more percent back on your contributions. And when it comes to retirement, there are now many more options than there used to be. You used to have to buy an annuity, and that was it. But you can go into drawdown now, and it's much easier. And you don't you're not forced to buy.
But effectively, though, when you kick the bucket, it's not your money.
Well, some of it is. Some of it is. Well, I mean, what do you care? But
Thank you, gentlemen. Those are really interesting ideas, and look forward to seeing you next time.
Cheers.